Let's talk about the economy and what scares and excites us. And rather than jump right into that, a couple weeks ago, somebody asked a question. I don't know if it was Andrew or Tim or Adam about who do you listen to when the Fed's speaking, and we have a Fed meeting tomorrow. But I really blew the answer on the question. So whenever I do that, since they're recorded, I always like to try and correct it later. So the real answer to the question, from my view, is it's Chair Powell, obviously, it's Brainerd, and it's Waller. But really, the other one that's not listed here, because he's not on the Board of Governors, but he is the head of the New York Fed, would be John Williams, who leads is the vice chair of the FOMC, is very important in rate setting. So those would be the three main ones. Others, Michael Barr's supervision, somewhat, but the others will play a role, and then you'll have people like Bullard who weigh in from time to time. But for us, the real message should be really Powell, Brainerd, Williams, and Waller would be the main ones I would listen to going forward. And we will have an announcement tomorrow. It looks like it's 50 basis points. We did see some positive numbers come out today in the CPI, which we'll touch on in a minute. So what scares me? And I'll just start with the word, it's debt. You know, I've talked about this a lot over the year, but we have a growing debt problem. We have a global economy that's roughly $101 trillion in US dollars this year. We have $300 trillion of debt globally, give or take, and global short rates rose 368 basis points this year. So you've added basically $11 trillion to your debt servicing costs on a $101 trillion economy. The implications of that will be there will be a lot of crowding out, and those who have the best needs will be harder to get their arms around. So let's just take a look at this. So a big number, it's grew at a pretty big rate. The positive thing is we had 6% GDP growth last year, which made the debt to GDP start to level off and look more attractive. But, you know, we just had a lot of distortions in the system. So I think that's one of the big worries for me is, you know, a lot of this debt was built on zero interest rates. It was built on the view, and much of it was built on MMT, modern monetary theory, which says debt really doesn't matter if you control the currency. And I think that's there are different views of that, whether you're at a zero interest rate environment or a couple hundred basis points higher. So I think that's one of the big issues that we have to think about. And the fallout from this is pretty significant because debt is the current consumption of your future earnings. You're borrowing today out of your future revenue streams to get something that you think is going to be more productive return for you over a reasonable period of time. The problem with that is not all the debt spend has been very productive and hasn't gotten the return that you need. So for advanced economies, you're creating this higher levels of debt with higher interest rates is going to squeeze capital from the areas that we need to invest to build the economies out. That's a big issue for the advanced economies. It's also one for the developing economies, but they have other problems that are layered on. They don't have the right access to the standards that we accept in the developed world. And that means that money has to go there in addition to going to the other areas that they need to invest in for the future growth. And that underinvestment is going to you get this crowding out of spending, you're getting underinvestment, which is going to compound the problems that these guys face. And just to give you a little sense of the lowest income developing nations, which is a subset of the developing nation group, their interest cost alone year over year grew 35% to $65 billion. These guys can't afford that kind of an increase on their system. And when you have currency depreciation in an inflationary environment with debt and other empowerment issues, you're going to have a developing problem, which makes it hard for governments to get longer term policies in place to move the needle forward. And just to give you a sense, most of the surge in debt ratios came from the emerging nations. And you can see Vietnam, Thailand, other nations really picking up a lot of their spend. Some of it's non-financial debt. The other worry that I have for the debt situation is so much debt moved out of the traditional lenders into the private markets, and you have not necessarily the same standards around that debt, which creates other liabilities in the system. And I think that's going to be one of the fallouts from Dodd-Frank, is that we used to know where the debt is and had standards for it. The policies we put in place to address those standards might be being circumvented by debt moving away from those institutions. So debt's a big problem for the world. There's some other ones. One big one for the other scare for me is labor supply and availability. We'll come back to that a little bit later. What excites me, though, is there is a cooling in the economy that's happening at a faster rate than people want to acknowledge. And the reason it's not coming down, it's being acknowledged as much, as you still have wage inflation and some of the other areas that are still keeping the inflationary numbers up. We had an interesting CPI number today. You've had a lot of areas where some of the things that were reflective of an inflationary environment are starting to turn. So let's look at it. Here's the dollar weakening, and just look at it from October to now, a very big move. And that really coincides with when the Fed started to talk about that they're going to be slowing their rate hikes. That would lead to a weakening of the dollar relative to other economies. And that's a big help. You also see it, used car prices coming down sharply now. They're still quite elevated, but prices at the pump have come down about $2 in a very short period of time as well. So you're starting to see areas that were big problems last year becoming, tailwinds for the inflationary story. And then that's then being reflected in the bond market, where yields have dropped from over 4.25 on the 10-year down to, in the high threes at 360, 370. So taking pressure off. You're seeing that with mortgage rates, which rocketed up quite a bit. They've backed off about 50 basis points. So again, a 50 basis point move from the 6% level or 7% level is meaningful. And I think this easing is starting to work through. And you've had these competing forces where the amount of stimulus that was in the system that was creating some of the inflationary pressures, particularly the $2 trillion of fiscal stimulus that came in, is now working through the system still, but a lot of the tightening that the Fed's been putting in is just starting to take hold. So you have these competing forces, which is why growth is still relatively okay and why there's good consumer spending on a relative basis still. But you're starting to see people react to the changes that are going on in the markets. The other thing is that's reflected in when you think you're getting to a peak in rates and a peak in inflation, that's more positive for the stock market. You have seen a slight rebound in the stock market as well. So the cooling of the inflationary pressures, to me, excites me because it will take some of the pressures off central banks to continue to put the upward pressure on rates, allow the system to have a shot at a soft landing, but they can't pull back too quickly on what the Fed's doing, or they'll give the inflation a chance to reignite. They need to get this cooling to be more persistent, and it's going to take some time to get there. But the trend is starting to develop where you're starting to see the inflationary pressures come in. So what other things that scare and excite? China scares me in the fact that their reopening could be really bad. Their COVID problem could get run away. Their real estate problem is still bad. They have terrible secular problems with demographics, and their corporations need to figure out how to work in a new environment. That's a big issue for me. The other one I mentioned is labor availability and supply. We could solve that pretty quickly if we had better policies, but I think that's a global issue that we have to deal with, that's creating some inflationary pressures up that we have to address. And I think the worsening social divide in the geopolitics is definitely something to keep us up at night. But our ability to solve the world's problems is there, but we can't do it unless we have greater prioritization. I think the things that the multinational organizations like the UN and others do with their 120-point programs are all great, but we have to solve the first 5 big ones first. We don't have the money or the wherewithal around the world to deal with this. And if we go into a recessionary period, then countries, instead of thinking about the greater global good, are going to be thinking about getting reelected and dealing with their own national problems. So you really have to narrow the scope of the problems we're trying to solve, solve them, and then move forward and solve the next ones after that. But we're trying to solve too many at once. If we get better focus in the US and other places, we can do much better. I think what's going on with the manufacturing renaissance is real and something we can leverage for the US. And I do think the other side of the China story is when they do reopen, it's going to have a big positive impact on global trade in a short sense of the reopening, like we've seen in other reopenings. And I think that could give a pretty significant boost to not only the Chinese stock market, but to other areas. And just lastly, the key themes for us as we go into next year at ARS are, we think these changes of globalization really need for everyone to rethink their assets, their investment strategies, and to make sure the areas that they're applying capital to are the areas that capital is still going to be moving to going forward. I think there's some pretty significant shifts as we've talked about. I think the other big change is we have to adjust to higher interest rates and higher cost of living, because even if inflation slows, we are moving from really a zero interest rate, 2% inflation mode to maybe a 4% interest rate, 4% inflation mode. And that's still a very different setup. And then I think what's gone on with sanctions, supply chains, the war in Ukraine and the trade wars that have been going on are going to lead to a reindustrialization of the global economy, again, creating some new opportunities, but also creating some new problems and new markets. So that's how we think about the big themes. I think the areas that are going to attract capital are the ones we need to solve problems for the world: electrification, digitalization, national security, biotech. Those are the areas that I think are going to continue to attract capital. I think you've seen a pullback in valuations that make it much more interesting for a lot of companies, but you still want to avoid the high multiple stocks. And I think you want to avoid many of the particularly low multiple stocks. A lot of them have earned it and don't have the strong balance sheets of the growth that they're going to need. We really like the prospects for North America and resource-rich developing nations, but we are, other than a short-term opportunity for a rebound in Europe and China, we are not very positive on the longer-term prospects of the structural challenges facing those areas. So we think it's going to be very much a stock picker's market against this backdrop. So Mark, I'll stop there and open it up to discussion.
Thanks, Stephen. Questions, comments? Yeah, what scares and excites you?
Yes, Stephen, regarding China and what's happening in China, not just China, but other parts of the world, but primarily China, how would you see the decoupling of these economies? How decoupled are we? I mean, it seems like the American economy is very strong. And the impact that China is having on that seems to be minimal. So my question is, China goes into deep recession. How impactful will that be on Europe and the United States?
When the second largest economy in the world goes into a recession, and it's been the economic engine for the world for most of the last 30 years, it's hard to say it won't leave a significant mark. The US is, I think you would look at the US as the best house in a bad neighborhood. But that would be it. It would see growth pull in for us considerably if China and Europe go, which is a possibility. But I think China, for all the head-scratching policies they've put out over the last year or so, I think everyone gets too quick to just write them off. They have a very robust economy. They have massive reserves. They have a command and control economy that they don't have to worry about Congress haggling over raising debt limits and things like that. So I think they can be very reflexive. And so I think you might have a short-term surprise on China and Europe next year, which then reverts back to longer-term structural issues coming to the fore. But if China goes, the US can't run away on its own without that moving. So.
Thank you, Stephen. One last question. You mentioned social divide.
Yeah.
Were you referring to wealth inequality or referring to the culture wars or both?
Both. I think we have a fraying of the social fabric around the world. And as the economic stresses pick up, you'll see the fraying increase. And the other thing that's happening around immigration issues, I think Europe may start to see some anti-immigration sentiment rising as the war continues on in Europe, and then the economic issues of each country come to the fore. It starts to be less, and it goes on for a longer period of time. I think the exhaustion of wanting to help the Ukrainian people versus dealing with your own nation's woes becomes in conflict, and I think leaders then tend to revert to their next re-election cycle. So I think that's one of the worries that I have with the social fabric shifting.
Okay, thank you, Stephen.
You're welcome.
Other comments?
Yeah, I had one, Mark. So Stephen, you had mentioned reindustrialization was one of the subjects that you anticipate is going to be, shaping up in the next year. How do you feel reindustrialization is going to happen in the United States? Because obviously with supply chain kind of exacerbating a lot of our issues, do you anticipate that we're going to start to see more, conventional industries respark capacity in the U.S.?
Well, I think it was last week that we did the reshoring thing, and the numbers are staggering. It's every industry. You're seeing it, but a lot of it is really the areas that have one of two problems: either lockdowns like China, or energy and labor potential challenges in Europe. So I think those two issues are, going to make Europe less competitive from manufacturing in the near term. And longer term, what's their energy supply going to be, and how fast, and what does that mean from a cost basis? And the other issue is the geopolitics of it, making safe and secure supply chains more important than lowest cost and fastest. I think that's a big change, and I think that favors the U.S. manufacturing.
So as to the subject of 361, how do you feel that impact investment is going to potentially spark in support of that reshoring? Or is it going to be pure industries like you're saying with energy and such?
I think the way impact is going to work is more of I think all industries have the opportunity for impact. We don't think we have a common definition of it either, but that's a separate discussion for somebody smarter than I. But I think it's really going to come down to how do companies think about what they're doing. And there is, it's funny, BlackRock, who is trying to take a lead, whether you think they were doing it well or not, they're still having protests outside their building on a daily basis.
Yeah.
So I think we got to do a better job defining what impact is, what ESG is, and then you can answer that question better.
So the age of greenwashing is certainly an issue.
Yeah, but I think you have to deal with certain realities. Like, you have to say there's a certain element of when you're making energy transition or a industrialization transition, there are going to be climate issues that you have to deal with up front. There are going to be cost issues and other unpleasant issues, but you have to deal with that in the light of the longer term. And I think that's really the trade-offs we have to make. Do you want to be beholden to the old supply chains? We've seen what's happened to Europe when you're beholden to old supply chains. It's not the place you want to be. So we're going to have to deal with some of the issues of having higher costs and other issues to make the transitions we want to make. And you can't do it as green as everyone wants to do it initially.
Thank you.
And
Mark,
Scott, I'm just going to just on the reshoring, Scott, you can see last week's briefing. I just put the link in there.
Thanks, Mark.
What Stephen did, he provided a lot of data around that too. Sorry, go ahead.
Yeah, I posted something in the chat box, and I would strongly encourage everybody to listen to this guy, Daniel Schmachtenberger. He's really one of the smartest global thinkers I've ever encountered. And he has been talking about this global secular shift that's taking place, go from what he's labeled, and he and his group of really smart people, game A to game B. And everything that Steve discussed, I think, is spot on. And you can see a contextualization of this transition period, which Stephen really talked about some real good detail on. Within the context of really what is the implications, and he has an incredible historical context of secular shifts that have happened on the planet, and there's models and examples in the past he cites. He said, you listen to him, and I have to put it on pause. You know, it's an hour conversation. You got to put it on pause, and it takes 3 hours if you research what he's talking about. He's a really smart guy and
Joe.
extraordinarily well informed. Yeah.
Why don't we bring him on here and you can
Oh, I
interview
would-
him.
Yeah, I've had some email exchanges with him. Never spoken to him personally, but I've had some email exchanges with him. I'll try. He is really as big a thinker as, and his thinking is well captured in various others that have had him.
Yeah.
This is the simplest one I linked because she was talking to kind of lay people, but you find him on YouTube and you'll see him talking even more details and granular and specifics with other groups as well.
He's a friend of mine, Mark. I can get him if you want.
Oh
There
my
you go.
goodness. No kidding, William. Holy cow.
Yeah, he's a great thinker, there's no doubt. I think he's got a
He
few
is.
holes in his theory, but he's got some very provocative thoughts.
Oh, man. Yeah, please do. That'd be.
Well, speaking of provocative, I like everyone's provocative input for their predictions here. As you can see, it's 361firm.com/2023. You can see what we did this 2 years ago and we did it last year. And we invite you to, if you want to do a video, you can post it, we'll post it. You can choose any of them. I can put somebody on the spot, but yeah, and then see if you were right with your predictions. But I welcome, we want like a lot of community views. You can do it by the form itself. And we'll post, well, actually, this will be the theme for next week as well. So we get more community, and if you can bring the guy in you're talking about, Daniel, William, that'd be awesome. Our community is our community. We can do things together. Sorry, someone else wanted about to speak. I may cut them off.
You didn't cut me off, Mark, but I did have a question / comment for Stephen. I glanced at the yield curve and it is stunning to see what's happened over the last couple of weeks.
Yeah.
I mean, pretty much everything except for the very short end has dropped considerably. So, you know, given the print that we had this morning on the CPI, it's pretty darn interesting. So yeah.
The one thing though, Bill, is I think we're still early in the data points to define a trend yet. I would put it in as encouraging, but I don't think it's going to change Powell's thinking.
Yeah, I think you're right. I think we're still in for it for a little while, but at least the shape of the trend is, as you say, is encouraging.
The other thing is the announcements from companies around staffing are really conflicting, because you have these labor contracts that are being renegotiated with massive numbers of 5 to 8% a year type numbers of increases. But then you have Goldman Sachs and others saying their bonus pools are going to be cut 50%, 30%, and the like. You're seeing wage increases, hiring freezes, and the like, and they all start to add up to a slowing of the wage trends, whether they're not showing up fully in the numbers yet. But I think in 6 months or so, you're going to see a very different kind of inflation picture if things keep on the trend. So I think there's something really worth watching the rate of change on a lot of these things. It's going to be very important over the next couple months.
Other comments?
Yes, Mark, not Mark, Bill, a question for you and Steve. The reverse repos, are those being increased, or are they steady? And how effective are they in taking the liquidity out of the market?
This is one of Bill's favorite subjects.
Yes, I know.
Here, let me pull the.
You want to share the screen, Bill?
let's see, sure. Let me get to.
Did you plant this question?
No, he didn't plan it. That's for sure. Okay, share screen, here we go. All
Didn't
right,
mean to put you on the spot there, Bill.
yeah, no, that's okay, that's okay. All right, did the chart come up for you?
Yep.
Yes.
Okay. So yeah, so here's the chart of the current volume of reverse repo that's happening. I think, you know, noticeably you can't even see the curve up until last year, when all of a sudden, you know, the Fed really started to go into action. And at this point, you know, interestingly enough, they were offering only 5 basis points for essentially banks to, you know, park their cash over at the Fed and taking government securities back in turn. You know, now of course it's a lot closer to the Fed rate that they're offering on it. But I think that this is an ace in the hole for the Fed, because if they want to get money back into the system, all they have to do is reduce the interest rate that they're paying on balances held in this repurchase agreement structure. And right now, you know, we are at here we go, just over 2 trillion, you know, dollars that's in here. This is absolutely a, you know, if they reverse this is a great source of liquidity, you know, for the market, where it's previously on the run up here. This was essentially tightening that they were doing by pulling out cash from you know, from bank reserves. And I think the last time we kind of had a vigorous conversation about this was, you know, more towards the early part of this year, and it was only at, you know, like 1.5, 1.4 trillion, you know, things like that. So we've added, so there's like, you know, not quite another $1 trillion that is parked in this reverse repo facility. So again, and this could be done, you know, more or less at the flip of a switch. So you could see a lot more liquidity coming back into the market if the Fed so desires, just by reducing the interest rate that they're paying on these transfers.
Do
there's
you
also been
expect them
some
to
talk about-
continue?
I'm sorry, go ahead.
Do you expect them to continue this tightening as they raise interest rates by 50 basis points?
Yeah, well, I think you know, this is tied to the Fed funds rate. So to the degree that they continue to increase the Fed funds rate, you know, the repo is going to be attractive, but it's relative to what the banks can do if they loan it out. And that's one of the key things. And I think that's yet another factor that you can see in here, because what this curve is saying is that the banks didn't see a similarly economic return for their balances. So instead they parked it over at the Fed.
Right.
So if, you know, if lending becomes a little bit better, you know, and now we've got an inverted yield curve, so that's not so great. But, you know, but if the banks become a little bit more generous with their lending, then you could see this curve kind of, you know, stay flatter. Because right now, you know, arguably, if you just, you know, just by inspection, so to speak, it's been relatively stable since July of this year. But it's a ton of money that's in this facility.
Stephen, you're going to say something?
Yeah, I was just gonna say, I think they start to blur, but I think it was 2 weeks ago, Mark, we did the proxy rate from the Fed, San Francisco Fed. It might have been 3 weeks ago. The San Francisco Fed came up with a new number for what they think the effective funds rate is if you factor in the QT, quantitative tightening, that they're doing. And remember, we switched from them doing quantitative easing of 125 billion a month to taking 95 billion a month out of the system. So almost $250 billion swing on a monthly basis. So that's created some tightening where they think the effective Fed funds rate with the tightening is upwards of 650 or so. So very different than the current rate that we're looking at. So that, in the Fed's view, the whole system is tightened up considerably from that perspective. And I think that is going to play into the rate structure over time. It just takes, it's new because we haven't really done quantitative tightening before. So it's going to be a new exercise to see how it really plays out. But I think we're going to see a lot of distortions in the treasury markets because of that and because the maturities and the roll-offs. And the Fed may actually do a form of Operation Twist where they start managing the maturities by sliding around where they're issuing new bonds and where they're reducing the counts. So that's something to keep an eye on as well.
Points, other questions, comments? Or answers to the questions, what scares you? What excites you for 23?
I'll pass on some excitement
Okay,
gained from a client last week. He's 79 years old. He's been investing internationally for 40 years. And he points out that GDP of the developing world in the next 10 years will equal that of the developing world. And these 7 billion young people have technology. They see what we got going on and they want it. And he's very, very optimistic that the future of the planet is bright. It's a long-term view. It's not next year. But, it gave me some optimism.
Morocco in the semifinals, give that area some optimism too. It means a lot. It means a lot in those countries to get there. So
absolutely.
Thank you, Stephen. Always, it was a moving tribute to John. Thank you for putting that together, Mark. Thank you for the introduction. Just over a year ago, through the 361 network, always bringing amazing people here. Thank you.
Thank you, Michael. Anyone else with a comment, question? What scares and excites?
Morocco scares. That is a hot team.
Brendan Hurley, what do you think?
Scoring a goal against Morocco is proving harder to do than anybody thought. Only conceded one goal so far, an own goal. I definitely will be cheering for them against France, and definitely will be cheering for Croatia this afternoon. But yeah, it's been a remarkably surprising but entertaining tournament.
18 yellow cards, Eddie.
Yeah,
I'm not going to comment on that, but I'm commenting on it. Morocco is the first African country to make it to the last four, and that should excite everyone who wants to be inclusive, because that's an excellent thing. And what I love about this particular cup is that it's so void of any hooligans and other troublemakers, and there's lots of camaraderie that gives me hope.
Yeah, it's funny you said that. There's an image of after the U.S. Iran game where one of the captain of the U.S. team or one of the players was consoling a sobbing Iranian player, and it really speaks to the sport and what can happen in the world today if you get governments out of the way. So I'm really moving. So
That's right.
Makes for a nice promo for FIFA. The clean board of FIFA.
that would be something to strive for. It's been corruption.
Well, I'm sitting in Germany. We don't have any dogs in the hunt here. But we have two Francophone teams, so the French are happy.